And I'm very happy to introduce, to welcome the speaker of the industry keynote, Kevin Daly. Kevin, welcome.
Thank you, Natalie. Thank you, Oliver. I've just discovered that I'm the only person in this room who won't be affected by MiFID II. Well, apart from you, but apparently you're lying, though. I was just told this. Apparently you will be. But to my knowledge, I wasn't affected by MiFID I either, so at least I don't think I was. So I plan to talk for about 20, 25 minutes, then open up for questions. What are the key messages I want to make? First, that global growth globally is tracking at a 3.5–4% annualized pace, so close to its long-term average. Second, these slides, by the way, if you can't read these at the back, they will be available afterwards. I think it would be challenging, so let me read them out for you. The recent market volatility was driven by concerns that global growth is slowing from this pretty moderate pace. But the evidence of slower growth is patchy, and we think the sharp fall in food and oil prices will support future growth. We expect global growth to remain broadly stable before rising next year. Inflationary pressures, crucial for the fixed income market, are very limited across the G4, and we expect them to remain so. That said, we also think deflation in the G4, including, importantly, the euro area, is unlikely. We expect significant cross-country divergence in growth rates to be maintained, with relatively strong growth in the US and UK, moderate growth in Germany and Spain, and relatively weak growth in France and Italy. So let me go on to this. This is a PMI-based global growth indicator. Tried many different indicators across time. This is the best indicator we find of global growth. And the interesting thing is here is, I'm going to jump down here if I'm going to lose. It's just really, actually, to the extent there's been worries of slowdown, it's been pretty stable here. I mean, these aren't impressive growth rates, far from it. 3.5–4%. is about in line with the global economy's, what we estimate, long-term average. But, they're not bad either. Now, what caused the market wobbles? So that was, back last slide, this is a real-time indicator of current global growth. This is a leading indicator of future growth. And you can see there is some signs of a downturn here. So this, and what really concerned the markets last month was you saw, everyone knows that euro area is weak. Everyone knows that, thank you very much. Problem is I've got two now, so I'll actually put that aside. Everyone knows the euro area is weak. There are concerns about China. But there were these, second-tier indicators that suggested the US was weakening as well. Now, retail sales for the US have never been a great indicator, I have to say. So the fact that the market sold off so much on US retail sales, particularly given what we've seen subsequently from the ISM, for instance, I think, shows really how worried the market, how caught up in market worries market participants had got. Because there are, pretty positive things to come from some of the developments that have happened in recent months. So oil prices have fallen $25 a barrel. Now, that's a really pretty significant decline. My wife, this sounds like the start of a really bad joke, but it's not. My wife, who's a very intelligent woman, but she's not interested in financial markets at all, so would know nothing of oil prices, came running into me literally 2 days ago, almost shaking me, saying, have you seen how cheap petrol prices have become? For those who live in the UK, so basically, to put it in context, normally it takes £70 sterling to fill up our car. It now took my wife £60. And that's a pretty big impact for household incomes. And what's more is that, for people who aren't focused on their computer screens, traders like yourselves, is that actually this really will come as a surprise, much as for my wife had that experience where she was, well, here's an extra £10 I have to spend on something else. Now, to put that in a less, should we say, anecdotal sense and a more sort of empirical sense. So these are estimates I show here from the IMF which includes, show what is the impact of a $25 barrel, $25 per barrel decline in oil prices. Now, ironically, the IMF was speculating that there would be a $25 increase. This was back at the start of October. They were concerned that the Iraqi problems would cause a big increase in oil prices, but we've actually had the reverse. And their estimates suggest that without confidence effects, the impact will be around 0.5% boost to GDP growth without 0.5%. But if you include confidence effects, so if you include my wife running in going, look how cheap everything has got, it actually rises to around 1.5% boost to the level of GDP, all else equal. That's a pretty big boost. Now, you may wonder, well, a lot of the concerns were driven by, well, oil price declines, have they been driven by, a lack of demand? Well, actually, our estimates suggest mostly not. I mean, there was a short-term supply factors and long-term supply factors. Short-term supply factors was, there was a lot of speculation in oil markets that because of the problems in Iraq, there would be a big reduction in supply from Iraqi oil. Well, that pretty much hasn't happened. The long-term effects, this is a challenging chart, even if you had it in front of you. It's even more challenging if you're trying to read it from the back. But stick with me a bit, because it is worth the effort. So this slide here shows the amount of oil production for different types of how basically the supply curve for oil has totally flattened in the last 6 years. So on the left-hand panel, this shows total production of oil, 2009, 2010. And it's like the amount, so on the x-axis, this is the amount of production that can be produced. And on this y-axis is at different dollar values per barrel, yeah? So you can see in 2009, actually that's not going to work because I'm going to block it if I go that way. In 2009, this is where I will use the pen. In 2009, it was very steep, yeah? So that meant that every time there was an increase in demand for oil prices would suddenly shoot up. But over time, 2010, 2011, 2012, 2013, 2014, it's become much steeper. And importantly, it's sort of flattening out at this $80 a barrel level. Why? Because new technologies, and in particular shale oil, is really increasing the amount of production, is flattening the supply curve. Now, this is a different way of illustrating. So this was how total supply curve of oil has flattened over time. This is now how different types of production, the supply curve looks. And you can see, importantly, it is this shale oil thing that is causing this big flattening in supply at the $80 a barrel. So that's, I mean, good news for the global economy. It also implies over time, I think, a more stable oil price level. Now, so we're relatively optimistic on overall growth remaining reasonably stable. There is, however, big cross-country disparities. This slide here shows composite PMIs now for the US, UK, and Euro area. And you can see that US, UK really pretty strong, Euro area a lot weaker. And that's, particularly exemplified in the labor markets, where what I think is remarkable about this slide is quite how close US and UK are in terms of unemployment, but Euro area much higher. So let me now focus. I want to say one slide in the US before I focus on Euro area. We're reasonably optimistic about US growth. Why? Because two reasons. Fiscal contraction is slowing, but also the private sector impulse. This slide here shows the bottom bars, shows the slowdown in the rate of fiscal contraction. Yeah, there's a big fiscal contraction in 13, 14, small one, 15, almost nothing is planned, at a time where private sector impulse is improving. Now, I want to spend the rest of my presentation focusing specifically on the Euro area and the UK. So what are the key points I want to make about the Euro area? First, the Euro area economic growth has faltered since the spring. Our Euro area current activity indicator has fallen from a rate of around 1.5% to 2% annualized to a rate of around 1% annualized. quite why this slowdown has taken place remains unclear. I mean, this may sound like a strange thing to say, is that given that the headwinds for the euro area are very well known and are very significant. So, you know, we have fiscal retrenchment. So what are the headwinds the euro area faces? As I say, they are well known. One is private and public sector deleveraging. The second is at a time where the banking system remains, particularly in the periphery, remains in very bad shape. And the third is in an environment of relatively weak growth and at least until recently, a euro area exchange rate or euro exchange rate that was clearly too strong, conditional on the weakness of the euro area economy. So you may say is that, you know, given these very severe headwinds, why are we surprised that growth has slowed? Well, the reason is that actually at the margin, these headwinds have actually been getting slightly better. I mean, this pace of fiscal consolidation has actually moderated in the euro area. The banking system in the periphery remains in terrible shape, but at the margin is getting slightly better, particularly now after the AQR. The euro exchange rate was too high, but has now clearly fallen. So actually, you know, our basic thesis, I don't want to sound too Panglosian, but our basic thesis is that a lot of the weakness you're seeing in the euro area at the moment is likely to be temporary. There are significant risks. You know, the euro area adjustment is far from complete. But, you know, over time we think that some of the weakness at the moment is overstated and will rebound. Meanwhile, euro area inflation has continued to grind lower. We think that the risk, nevertheless, we think the risk of sustained deflation is limited. Why? For two reasons. One is, actually through this period, core deflation has remained relatively stable at just below 1%. But the second thing is, actually, it's really pretty difficult to generate deflation in an economy with a floating exchange rate. I mean, everyone looks at Japan and look at, you know, the problems with Japan. But Japan is, you know, we have looked at every inflation data for literally every single country going back to the Second World War. And Japan is, of countries with floating exchange rates, you can find many countries with fixed exchange rates or in currency unions, their deflation is relatively common. But if you have a floating exchange rate or an independent monetary policy, as the euro area does in aggregate, then actually deflation is very rare. Japan is literally unique. And in Japan's case, what's interesting is that actually, even in Japan, you know, given that the crisis began in 1990 in Japan, it took all the way till 2000 for Japan to finally fall into deflation. So even Japan's example suggests that the risks of deflation are relatively low. And actually, you don't just need to be slightly behind the curve, but really a country mile behind the curve to generate deflation. So we think that the risk of deflation in euro area, you know, the ECB policy has been behind the curve, but not quite as bad as Bank of Japan. And we think there's significant, but inflation will remain low. We think more of the measures from the ECB will come from credit easing rather than quantitative easing. So let me go through some slides. Here are our forecasts for the euro area. We do expect a slow but gradual improvement in growth. With big, significant cross-country disparities in the growth rates. So Germany doing well, Spain doing relatively well, France and Italy doing badly. Italy, I think, is the biggest risk to the long-term future of the euro area. Here's two of the big problems. This shows the difference in bank lending rates across the euro area remain relatively high. So much lower bank lending rates in France and Germany than in Italy and Spain. And this is only healing slowly. It's good to see, though, in Italy, so this country, actually you've seen a much bigger healing, relatively rapid healing in bank lending rates. As I think in Spain has done a much better job than Italy in sorting out its banking sector. And lastly, the second big factor that is causing these big cross-country disparities is the pace of fiscal consolidation. So much more fiscal consolidation in Italy, France, and Spain than there is in Germany, particularly in Italy and Spain. And pretty soberingly, I talked about the positive factors, but pretty soberingly, actually there's still in France and Italy and Spain quite a lot of fiscal consolidation still to be done. Although the pace has now slowed, there's still quite a bit to be done, whereas Germany is obviously in a much different place. Now, on deflation, or the risk of deflation, we obviously have these very low inflation rates, but as I say, I won't go through this again, but as I say, a lot of that is due to non-core prices. Core is clearly too low, but has been relatively stable at around 1%. The ECB, which is the forecasts are shown in these bars, and ourselves expect it to rise very slowly over time. And lastly, but clearly not least, for an audience such as this, ECB policy, this shows, it's difficult to know what slide really to show this. This shows, however, the size of central banks' balance sheets. And one of the key issues for the ECB, if you can see it, has been that because of the repayments of the LTROs, you've actually seen a shrinkage of the ECB's balance sheet. So trying to reverse that process is really a crucial thing. Now, for us is that, there is a view, everyone in fixed income markets very much focused on sovereign QE, the probability, the likelihood of sovereign QE. And there is, when I talk to clients, there is a real sense that, these are the measures that they've done, the credit easing measures, the ABS, the targeted LTROs and so forth. These are the amuse-bouche, if I can put it that way, before the main course of the sovereign QE when it comes. Actually, I would argue that if you look at the experience of the UK and you look at the experience of the US, it was the credit easing measures. UK is a great example here, and I'll come back and talk about the UK in a bit. UK had 3-4 years of QE, pure QE, so it's just they only bought gilts. And it pretty, spectacularly failed. I mean, it's good for fixed income markets, so it's good for people here is that you had a big rally in UK fixed income. But in terms of the impact on the wider economy, QE creates a lot of liquidity, which if banks are unprepared to lend out into the wider economy, will simply accumulate on banks' balance sheets without being prepared to, who are then not prepared to lend out into the wider economy. So what the UK really needed, or the transformational point in the UK, was when they launched the credit easing initiative, the FLS, the Funding for Lending Scheme, in mid-2012. And also you had Mario Draghi's whatever it takes commitment. Both of these things contributed to driving down the funding costs of banks and encouraging them to lend. So from the UK's experience, it would suggest that actually QE was pretty ineffective, and credit easing, FLS type measures, they were actually pretty effective. The same experience you get from the US, where they find that of the Fed's quantitative easing program, because the Fed's quantitative easing program always had a credit element to it because they were buying mortgage-backed securities in addition to treasuries. In the US, they find that a lot of analysis to suggest that it is the purchase of mortgage-backed securities were really the very effective bit of the Fed's quantitative easing program. So then you transfer this over to the experience for the euro area, and you wonder, well, really is QE what the euro area needs, or are the measures that they've already introduced, the targeted LTRO, which the ECB have said is designed specifically on the back of the FLS? I mean, my own view is that I think these measures that have already been introduced are likely to be more effective, given that sovereign yields in the euro area are already very low. Also, importantly, in terms of anticipating whether sovereign QE is likely in the euro area, it's important to bear in mind that this is also what they think at the ECB. They are highly skeptical of whether sovereign QE will have important positive effects over and above the measures they have already announced on the credit easing front. Now, the second reason to expect sovereign QE not to happen is, of course, the political concerns, particular political considerations which are important for the ECB in a way that aren't relevant for the Bank of England and the Fed. I mean, we would put the probability of sovereign QE for the euro area at around 30%. It can certainly can happen if the situation deteriorates significantly, but it's not our base case for sure. Now, I'm going to finish up with some points on the UK. And just say first, the characterizing feature of our UK forecasts has been our view that growth will be stronger than consensus expectations, but inflation will nevertheless be weaker than consensus expectations. Business surveys and labour market data imply that UK growth remains strong. The composite PMI, which we saw earlier, is consistent with growth of around 4 to 4.5%. Our current activity indicator is consistent with 3 to 3.5% annualized growth. We expect the ongoing recuperation of the UK's banking system and the associated improvement in credit provision to continue to support the recovery. Nevertheless, there are, the UK is now facing more headwinds, the weakness of growth in the euro area, and the effect of sterling appreciation over the last year. So here's a slide of UK growth. So the black line is GDP growth. The blue line is our current activity indicator. I mean, for those, actually, can I have a hands up? How many are resident in the UK here? So yeah, a good majority, I would say. So for those who are resident in the UK, do you remember? I mean, you will remember at the start of last year that. I mean, the UK it seemed that it couldn't fall any further. I mean, there's talk of triple-dip recessions. Everyone was, the UK was considered a basket case. And yet, in the year and a half, 2 years since then, we've had a total transformation. It's like a Lazarus-like transformation. So, and this often has happened without people really wondering, well, what is it that specifically drove this? And the argument that we have made, part of it I said in the section on the euro area, is a lot of it was driven by really improving the banking system. And this is, actually I'm going to skip on to this slide here in the needs of time. And you see that in through 2009, 10, 11 and 12, this slide here shows funding costs for UK banks, so CDS spreads for UK banks. And the dark blue line is unsecured bank funding spreads. You see through 2009, 10, 11, 12, despite a huge amount of QE, the funding costs of UK banks remained high and pretty volatile. And it was in mid-2012, the Bank of England had a Saul on the road to Damascus conversion and launched credit easing, launched the FLS, the Funding for Lending Scheme, in around this point here, and it caused this huge reduction in banks' funding costs through this period. That and obviously the reduction in euro area concerns driven by Mario Draghi's whatever it takes commitment. The combination of these two things resulted in a big reduction in banks' funding costs. With the result in this slide, this now shows the dark line shows the rate that banks lend out at to the wider economy. The blue line shows a measure of their funding costs. The difference between the two is banks' margins. So you can see for the first time, really, banks opened up, had a real incentive to open up for business. I don't know how many of you who live in the UK remember at the start of 2013, suddenly, so about 6 months after these measures were introduced, at the start of 2013, all of the UK banks simultaneously ran a massive advertising campaign. So there was Nat, yes, 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 we say yes to 8 out of 10 mortgages, and there was a whole host of them. But collectively, the banks opened up for business, and that was really the transformational point, we think, for the UK. Now, set against that process I still think is ongoing. It's still a positive process. Set against that, you have had a big rise in the sterling exchange rate in the last year and a half, which will weigh in growth, and obviously the weakness of euro area growth is also negative for the UK. Finally, on inflation, as I say, is that the characterizing feature of our UK views has been we are above consensus on growth, we are below consensus on inflation. The reason why we reflects our optimism on potential output in the UK economy. We think there's a lot of room to grow in the UK economy. And you have seen this, big decline in inflation in the UK, which, we think out to the forecast horizon, the UK will remain, inflation will remain below the MPC's target. Now, that said, I do think that some of the markets, the extreme rally you saw in UK fixed income in the last month, some of that was exaggerated. We've generally been on the dovish side of policy. We still think that the Bank of England will raise rates for the first time in early of next year. I think the risks around that are clearly more skewed towards a later move. But for now, at least, we're holding on to that view. We do think that the market has overreacted, in part because of, as related to the point earlier on, we think some of the concerns over global growth are overstated. So let me just finish by recapping. What are the points that I've tried to make? One is that global growth is tracking at a 3.5% to 4% annualized pace. Not fantastic, but actually not so bad either. The recent market volatility was driven by concerns that global growth is slowing from this moderate pace. But three, the evidence of slower growth is patchy, and the sharp fall in oil and food prices will provide support for future growth. We expect global growth to be broadly stable before rising next year. Four, inflationary pressures are very limited across the G4. That said, we think the risk of deflation is also limited, including in the euro area. I mean, you may get a very temporary bit of negative inflation in the euro area, but sustained deflation, we think, is the risk of that is limited. And lastly, we expect significant cross-country divergences in growth rates to be maintained, with relatively strong growth in the US and UK, moderate growth in Germany and Spain, and relatively weak growth in France and Italy. And if there's time, I will now leave it for questions. How much time? The clock that tells me what time I have is broken here, so I don't know how much time. I may have talked for an hour. I don't for all. 3 minutes. Any questions? This is where I wish I planted a question in the audience before I started. Oliver, you're holding the microphone. You may have to ask a question if no.
Morning.
Morning.
Kevin, you mentioned a couple of times the threat of deflation, and indeed you referenced Spain a couple of times. Have you, in your studies of deflation, noted any linkage between the episodes of deflation and growth? Because certainly when we look at Spain over the course of the last 1 or 2 years, the deflationary impact, or certainly the reduction in inflation, has coincided with quite a strong rate of growth.
Yeah, so, I mean, that's a very good question. Thank you. So, I said in this episode of looking at episodes of deflation across time, Japan, amongst countries with a floating exchange rate and independent monetary policy, Japan is unique. But also, as I said, there were a number of instances, of which Spain is a clear example, of countries with either a fixed exchange rate regime or within a currency union where deflation has occurred, and because they don't have independent monetary policy or a floating exchange rate. In those instances, actually, it is a pure, it is a pure competitive gain. The only way that you can regain competitiveness within a currency union is through running deflation. So you saw that in Ireland, my own country. You've seen it in Spain. And the countries, you're absolutely right. In that instance, the countries that have been quicker to make that adjustment in their cost competitiveness have been it's been very painful, but they've been relatively quick to bounce back to growth. So for the most part, deflation for individual countries within a currency union, I think it is a positive thing. But where you see deflation for a monetary area as a whole, like Japan, or hopefully not, but possibly the euro area, then that is almost wholly bad. It shows that the monetary authority has made not just a small mistake, but has made a massive mistake over a very prolonged period of time. Because as I say, in Japan's case, it took them literally 10 years. I mean, they weren't just a little bit behind the curve. They were 10 years behind the curve before they managed to generate deflation in Japan. That's how bad things needed to be. So I think that's the distinction. I think that has to be the last one, actually. So.
Hi, Bryn Jones from Rathbones.
Hello.
Yeah, just a quick question. There's a big disconnect between what the Fed dots are saying and what the US Treasury curve is saying.
Sorry, I can't actually quite hear.
Yeah, so there's a big disconnect between what the Fed dots, the Fed forecasts are, and the US Treasury curve currently. The Fed are obviously forecasting rates a lot higher than the Treasury curve is saying. And interestingly, last month, the Taylor rule, which is obviously what the Fed have been following for a number of years, turned positive for the first time. There's no accident that they ended QE at the same time. When do you think the rates are going to go up in the US, if at all, with this low inflationary growth?
So our US economists are, I mean, Jan Hatzius has been pretty dovish, through this. He's known as being one of the biggest doves on the street. I tend to, I'm not just saying this because, because I'm towing the Goldman's line, as it were. I actually agree with them. I tend to think that, the more dovish perspective is the correct one. Now, Jan, interestingly though, he believes lower for longer in order to make sure that the economy has built up a degree of momentum, but that when rates do begin to rise, he thinks that rates will rise pretty quickly. So flatter than the US yield curve, out for the next year, so lower rates than implied by markets currently for the next year or so, but then after that actually steepening quicker than the market is pricing in, which is actually not far from what the dots are implying. Okay, so enjoy the rest of the conference and enjoy Barcelona, and thank you very much.